Hi, welcome back. Today we're looking at something that confuses a lot of silver investors. And honestly, it confused me for a long time too. Most people assume that when war breaks out somewhere important, silver should shoot higher, right alongside gold. It's a metal, it's scarce, it's a safe haven, so conflict should be good for the price. But history keeps showing us something different. When real geopolitical shocks hit, especially ones that threaten global trade routes, silver often does the opposite of what people expect. It stumbles, it drops, and sometimes it drops hard, even while gold is climbing. Today we're going to unpack exactly why that happens, using one of the most sensitive flashpoints on the planet as our example, the Strait of Hormuz, and what a blockade there would actually do to silver, industrial demand, and the entire manufacturing engine of Asia. Now this matters right now, because tensions in the Middle East have a way of resurfacing every few years, and the Strait of Hormuz keeps coming up as the pressure point that could shake global markets overnight. It's a narrow waterway, only about 21 miles wide at its tightest point, sitting between Iran and Oman. Roughly a fifth of the world's oil and a huge portion of global liquefied natural gas passes through that channel every single day. When people talk about this region becoming unstable, they're not exaggerating the stakes. A serious disruption there wouldn't just be a headline for a day, it would ripple through energy markets, shipping routes, and eventually, industrial production everywhere. And because so much of modern manufacturing depends on stable, affordable energy, a shock at this single choke point has the ability to touch nearly every corner of the global economy within days, not months. So here's the question we're really answering today. If war breaks out and this critical shipping lane gets choked off, why wouldn't silver just rocket higher like everyone assumes? Let's break this down step by step, because once you see the mechanics behind it, it actually makes a lot of sense. Start with the basic identity crisis silver has compared to gold. Gold is almost purely a monetary asset. Central banks hold it, investors hold it as insurance, and it has very little industrial use pulling on its price. Silver is different. Yes, it's precious. Yes, it's used as a store of value. But more than half of all silver demand every year comes from industry. Solar panels, electronics, electric vehicles, medical equipment, semiconductors, all of that eats through enormous amounts of silver. Think about it this way. Gold behaves like an insurance policy, something you buy hoping you never need to use. Silver behaves like insurance and raw material at the same time, which means its price gets pulled in two completely different directions whenever a crisis hits. Now here's where the Hormuz scenario becomes so important to understand. If that strait gets blocked, even partially, oil prices spike almost immediately. Energy is the lifeblood of manufacturing, especially in the parts of Asia that consume the most silver in the world. China, South Korea, Japan, and Taiwan are massive industrial silver users, running huge factories that produce solar panels, chips, and consumer electronics. Nearly all of that manufacturing runs on energy imported through, or priced off, Middle Eastern oil flows. When energy costs spike suddenly, factories don't just shrug it off. Production costs jump, margins get squeezed, and companies start slowing output or delaying orders until the picture becomes clearer. This is the part a lot of people miss. A Hormuz blockade doesn't just threaten energy security, it directly threatens the demand side of the silver market. Remember, more than half of silver's use comes from industrial buyers. If those buyers are suddenly dealing with soaring energy costs and possibly slower economic activity because their own customers are pulling back too, they don't need less silver in theory, they need less silver in practice, at least in the short term. Factories that make solar cells or circuit boards can't just absorb massive cost increases forever. Some will scale back, some will pause, some will wait for prices to settle before locking in new orders. Now layer on top of that a wave of fear moving through financial markets generally. When a real war scenario hits, especially one touching global energy supply, investors don't just calmly rotate into precious metals. There's often a scramble for cash. Leveraged positions across many assets get unwound quickly. Margin calls hit trading accounts, and in the chaos, even assets that should theoretically benefit from a crisis get sold off, simply because investors need liquidity fast. Silver, being a smaller and more thinly traded market than gold, tends to see sharper price swings in both directions during these liquidity crunches. That's part of why silver can drop hard in the early days of a major shock, even while the long-term case for owning it hasn't changed at all. Here's another piece of the puzzle worth understanding. What if gold tends to be driven by central banks, large institutions, and macro investors who are thinking in terms of currency stability and long-term reserves? Silver's price action leans more heavily on industrial buyers, manufacturers, and retail investors, groups that respond much faster to short-term economic pain. So when a shock like a Hormuz blockade hits, gold buyers are often thinking years ahead, while silver-related businesses are thinking about next quarter's production costs. That mismatch in time horizon is a major reason the two metals can move in completely different directions during the same crisis. Let's talk about Asian manufacturing specifically for a moment, because this region is really the heartbeat of global silver demand. China alone accounts for a massive share of global solar panel production, and solar technology has become one of the fastest-growing uses of silver on the planet. South Korea and Taiwan dominate advanced semiconductor manufacturing, another silver-intensive industry. Japan remains a major electronics producer as well. All of these economies depend heavily on energy imports, and a meaningful share of that energy either passes through or is priced in relation to flows from the Persian Gulf. If shipping through Hormuz becomes dangerous or restricted, energy costs across this entire manufacturing region can rise quickly, and that pressure moves straight through the supply chain into decisions about silver purchasing. A solar panel manufacturer, for example, doesn't just buy silver paste whenever it feels like it. Purchasing is tied closely to order books, and if energy costs make production more expensive while demand from end customers softens at the same time, the natural response is to slow down purchasing until the picture clears up, not accelerate it. Now I want to pause here and give you a quick reminder because I think it's genuinely useful. If you've found this kind of breakdown helpful, consider hitting like on this video and subscribing to the channel. It genuinely helps this content reach more people who are trying to understand these markets clearly without hype or noise. No pressure at all, just something to think about as we keep going, because there's more nuance ahead that I think you'll find valuable. So does this mean silver is doomed every time geopolitical tension rises? Not at all, and this is where balance matters. The initial reaction to a shock, especially a sudden and severe one like a Hormuz blockade, tends to be dominated by fear, liquidity needs, and industrial demand concerns. But that's usually the first phase, not the whole story. If a conflict drags on, and inflation starts creeping higher because of persistently elevated energy prices, precious metals as a whole often regain their footing as investors look for protection against a weakening currency and rising prices. Silver can absolutely recover and in some cases outperform once the initial panic settles and the inflationary consequences of the conflict become the dominant theme instead of the immediate demand shock. Think about it this way. A war or blockade creates two separate waves that hit the market at different times. The first wave is deflationary in a sense, industrial slowdown, demand destruction, panic selling, and a rush for cash. The second wave, if the conflict persists, tends to be inflationary, driven by sustained higher energy costs, disrupted supply chains, and governments potentially increasing spending or money creation to manage the crisis. Silver often struggles in that first wave, and then has the potential to shine in the second one, assuming the underlying supply and demand fundamentals for the metal remain intact. It's also worth acknowledging that not every analyst agrees on how severe the initial silver reaction would actually be. Some market watchers argue that silver's structural supply deficit, the fact that annual mine production has been falling short of total demand for several years running, could offset some of the short-term industrial pullback, especially if investment demand for physical silver picks up as a hedge during the crisis. Others believe the industrial demand shock would dominate in the early weeks, regardless, simply because factories react to costs faster than investors react to headlines. Both perspectives have merit, and the truth in any real scenario would likely depend on how long the blockade lasts, how severe the oil price spike becomes, and how central banks and governments respond in those first critical weeks. Here's a simple mental framework you can carry with you whenever a geopolitical shock hits and you're trying to figure out what it means for silver. Ask yourself 3 questions. First, does this event primarily threaten global energy supply and shipping routes? If yes, expect industrial demand concerns to weigh on silver initially. Second, how leveraged and crowded are precious metals positions heading into the event? Heavier positioning often means sharper initial swings in both directions as traders adjust. Third, is this shock likely to be short-lived, or could it drag on and become a sustained inflationary pressure? The longer a disruption lasts, the more likely silver eventually benefits from the inflation and currency debasement angle, even if it struggled in the opening days. Looking ahead, there are a few paths this kind of scenario could take, and it's worth thinking through them without assuming any single outcome. In one path, tensions rise, but a full blockade never fully materializes. Oil prices spike briefly, then ease, and silver experiences a short, sharp dip before stabilizing as normal trade flows resume. In another path, a partial or extended disruption occurs, energy costs stay elevated for months, Asian manufacturing genuinely slows, and silver goes through a more prolonged period of weakness tied to real demand destruction before eventually finding support from the broader inflation narrative. In a more severe path, an extended conflict triggers a global recession scare, and silver could see significant volatility in both directions as investors weigh recession fears against inflation fears simultaneously, a genuinely difficult environment for any asset to navigate cleanly. Now let's connect all of this back to something practical for your own financial thinking. If you hold silver, or you're considering it as part of a broader portfolio, understanding this dynamic matters because it helps set realistic expectations. Silver is not a simple crisis hedge the way many people assume. It's a hybrid asset, part monetary metal, part industrial commodity, and that dual nature means its behavior during geopolitical shocks can genuinely surprise people who haven't thought through the industrial demand side of the equation. Knowing this ahead of time can help you avoid being caught off guard, and it can help you interpret news headlines about conflict with a clearer, more grounded perspective rather than reacting purely on emotion. It's also a useful reminder about diversification and time horizon generally. Precious metals, like any asset, don't move in a straight line, and short-term price action during a crisis doesn't necessarily reflect the long-term supply and demand picture for the metal. The structural deficit in silver mining supply, the growing industrial applications in solar and electronics, and the ongoing role of silver as a monetary asset are all long-term forces that don't disappear just because a geopolitical event creates short-term turbulence. Understanding the difference between what moves silver in a week and what moves silver over several years is one of the most valuable lessons any precious metals investor can learn. So let's bring this together. Silver often stumbles during severe geopolitical shocks, like a potential Hormuz blockade, not because the crisis is bad for silver's long-term story, but because the immediate effects hit its industrial demand base hard, while simultaneously triggering broad market liquidity stress that pulls even safe haven assets lower in the short run. Gold, being more purely monetary, tends to hold up better in that first wave. But if the conflict persists and inflation becomes the dominant concern, silver has historically had the potential to catch up and even outperform once that shift happens. The key takeaway is that silver's dual identity as both an industrial material and a monetary metal makes it uniquely sensitive to the specific nature and duration of any crisis, and understanding that distinction is far more useful than simply assuming metals always rise together during conflict. That's the picture for today. None of this is financial advice, just an attempt to walk through the mechanics clearly so you can form your own view with better context. Markets are complicated, geopolitical events are unpredictable, and nobody can say with certainty exactly how any future crisis will play out. If you found this useful, I genuinely appreciate you sticking around, subscribing if you haven't already, and letting me know in the comments what topic you'd like broken down next. Thanks for watching, take care of yourselves, and I'll see you in the next one.